On January 1st, 2026, at exactly Aura 1 Beijing time, the world's largest silver refiner implemented the most restrictive export licensing system in modern commodity history. The decision, buried in a routine administrative notice from China's Ministry of Commerce, received no international headlines, no emergency UN sessions were called, no currency markets collapsed overnight. The silence was deliberate, calculated, and absolutely devastating for anyone who understood what had just occurred. China had effectively severed the global silver supply chain with the stroke of a bureaucratic pen. Within 72 hours, the tremors would reach London. Within a week, they would shake New York to its foundation. And within 30 days, the ripple effects would fundamentally restructure how the world values and trades the most critical industrial metal of the modern age. This was not a trade dispute. This was not a negotiating position. This was the implementation of a resource warfare strategy that had been 15 years in the making. The numbers behind China's silver dominance tell a story that most Western analysts have chosen to ignore. China controls approximately 60% of global silver refining capacity. They process raw ore, not just from their own mines, but from Argentina, Mexico, Peru, and Chile. Silver enters China as rough concentrate and emerges as 99.99% pure bars, ready for industrial use. For decades, this refined metal flowed freely to electronics manufacturers in South Korea, solar panel producers in Germany, and automotive suppliers in the United States. That flow stopped at midnight on New Year's Day. The new export licensing requirements appear bureaucratic on the surface. Any company wishing to export more than 80 tons of silver annually must now obtain government approval. They must demonstrate a creditworthiness of at least 30 million yuan. They must justify each shipment with end-user certificates and provide quarterly reporting on destination markets. These sound like reasonable administrative safeguards until you understand the implementation reality. The approval process takes a minimum of 90 days. The creditworthiness requirements have eliminated 80% of existing exporters overnight. The end-user certificates must be verified by Chinese consulates in destination countries, creating additional bottlenecks. And perhaps most critically, the total volume of approved export licenses will be capped at 40% of 2025 levels. China has not banned silver exports. They have simply made them practically impossible. But the administrative machinery was never the real story. The real story lies in why Beijing chose this moment to trigger what industry insiders are calling the silver squeeze protocol. The timing was not coincidental. It was surgical. Western intelligence agencies have known for years that China views silver not as a commodity, but as a strategic resource equivalent to rare earth minerals or lithium. Silver is the nervous system of the modern economy. It conducts electricity better than copper, reflects heat better than aluminum, and resists corrosion better than steel. Every smartphone, every electric vehicle, every solar panel, and every advanced weapon system depends on silver to function. China has been steadily increasing its domestic silver consumption while maintaining export levels through a deliberate strategy of importing raw materials and exporting finished products. They bring in silver ore from South America, refine it in Hunan and Jiangsu provinces, and send a portion back to global markets while retaining the majority for domestic use. This created an illusion of continued supply availability while China was actually absorbing an increasing share of global production. The export licensing system represents the end of this illusion. China is keeping the silver. The first casualties appeared in the electronics sector. Samsung's Galaxy production line in South Korea relies on Chinese silver supplies for circuit boards and contact switches. Their procurement officers received notification on January 3rd that their regular suppliers could not fulfill January orders due to pending license applications. Alternative suppliers quoted delivery times of 12 to 16 weeks, assuming they could source material at all. Tesla's Gigafactory Shanghai faced similar constraints, but with a twist that revealed the broader strategic implications. Chinese suppliers were still able to provide silver for Tesla's domestic production, but export restrictions prevented shipment of components to Tesla's facilities in Berlin and Austin. The message was unmistakable. Foreign companies could continue operating in China, but they could not easily relocate production elsewhere. The solar industry faced the most severe immediate impact. Photovoltaic panel manufacturing requires silver paste for conducting pathways, and China controls 80% of global solar panel production. European solar installers, who had built their business models around cheap Chinese panels, discovered that their supply chains had evaporated overnight. German companies like SolarWorld and Q-Cells scrambled to identify alternative suppliers, only to find that non-Chinese manufacturers were already operating at full capacity with waiting lists extending into 2027. Industrial demand represented only the beginning of the crisis. The real acceleration came from an unexpected source: central bank reserves management. The Bank of England was among the first to recognize the implications. Their commodities desk understood that if China controlled 60% of refining and was restricting exports, the available supply to Western markets had effectively contracted by more than half. Physical silver, like gold, serves as a hedge against currency devaluation and geopolitical instability. But unlike gold, silver has irreplaceable industrial applications that create baseline demand regardless of investment sentiment. On January 8th, the Bank of England quietly authorized the purchase of 50 million ounces of silver for strategic reserves. They were not alone. The Reserve Bank of Australia, Banco Central de Brazil, and the Bank of Canada issued similar acquisition orders within days of each other. Central banks, institutions that typically move slowly and deliberately, were panic buying silver like retail investors chasing a meme stock. This institutional stampede created a secondary squeeze that compounded the supply restrictions. Central banks do not trade silver futures or hold paper contracts. They purchase physical metal and store it in secure vaults, removing it permanently from circulating supply. When multiple central banks simultaneously attempt to acquire large quantities of physical silver, they compete directly with industrial users for the same finite inventory. The pricing dynamics became increasingly distorted as this dual pressure intensified. Paper silver futures, traded on exchanges like COMEX, continued reflecting pre-crisis assumptions about supply availability. These contracts represent promises to deliver silver, but the underlying physical metal was becoming increasingly difficult to source. Industrial buyers who had relied on just-in-time delivery began paying premiums of 15-20% above futures prices to secure actual metal from dealers and refineries. By January 15th, a clear bifurcation had emerged between paper and physical markets. Futures contracts suggested silver was trading at $31 per ounce, but industrial procurement managers were paying $38-40 for immediate delivery. This spread, known in commodity markets as basis, typically ranges from a few cents to perhaps $1 in extreme circumstances. A $7.09 basis indicated systemic dysfunction in the pricing mechanism. The arbitrage opportunity was obvious, but impossible to execute. Sophisticated trading firms could theoretically buy futures at $31, take delivery, and sell physical metal at $38 for a risk-free profit. However, taking delivery from COMEX required significant volumes, storage facilities, and most importantly, available metal in exchange warehouses. The Chinese export restrictions meant that warehouse inventories were not being replenished, while industrial demand continued draining existing stocks. COMEX registered silver inventories, which represent metal available for immediate delivery against futures contracts, fell from 84 million ounces in December 2025 to 31 million ounces by mid-January 2026. This drawdown occurred during historically low trading volumes, indicating that a small number of large buyers were systematically removing metal from the exchange. The silver market was experiencing a slow-motion run on the bank, with industrial users and the central banks competing to claim the remaining physical inventory before it disappeared entirely. The geopolitical implications became clear as the crisis deepened. China's export restrictions were not random administrative decisions, but calculated moves in a broader economic competition with the West. By controlling silver supply, China could influence the production costs and availability of critical technologies developed by foreign competitors. American defense contractors building advanced missile systems, German automotive companies producing electric vehicles, and Japanese electronics manufacturers creating next-generation semiconductors all suddenly faced supply chain vulnerabilities they had never anticipated. This resource leverage extended beyond simple pricing pressure. Chinese officials began privately indicating that export licenses might be more readily available for countries that aligned their foreign policy positions with Beijing's preferences. Nations that supported Chinese positions on Taiwan, reduced cooperation with American military initiatives, or increased trade relationships with China found their license applications processed more quickly. The silver supply chain had become a tool of diplomatic influence. The European Union recognized the strategic implications and convened emergency sessions to discuss supply chain resilience. However, their options were limited. Building new silver refining capacity would require 3 to 5 years and massive capital investment. Developing alternative supply relationships with producers in Mexico or Peru would still require Chinese refining services, as these countries lacked the infrastructure to process ore into industrial-grade metal. Europe was discovering that decades of efficiency-focused globalization had created critical dependencies that could not be quickly unwound. American policymakers faced similar constraints, but with additional complications. The United States had historically maintained strategic stockpiles of critical materials, but silver reserves had been largely depleted during the 1960s and never replenished. The Defense Logistics Agency, responsible for ensuring material supplies for military production, found itself competing in spot markets alongside industrial buyers, driving prices even higher while struggling to secure adequate quantities for weapon systems and communications equipment. The The silver squeeze revealed a fundamental vulnerability in Western economic architecture. Supply chains had been optimized for cost efficiency rather than resilience, creating single points of failure that could be exploited by strategic competitors. The assumption that critical materials would always be available at market prices proved naive when the primary supplier decided to prioritize domestic interests over global market stability. Industrial companies began implementing emergency response protocols that had not been tested since World War II. Apple initiated Project Silver Shield, an effort to secure 18 months of silver inventory through alternative suppliers and recycling programs. Tesla announced partnerships with South American mining companies to develop processing capabilities outside Chinese control. Samsung established a strategic materials division tasked with identifying and securing supplies of critical components across all product lines. These corporate responses created additional demand pressure as companies shifted from just-in-time inventory management to strategic stockpiling. The psychology of scarcity took hold, with procurement managers preferring to hold excess inventory rather than risk production shutdowns. This behavioral change transformed temporary supply restrictions into sustained demand increases that persisted even after initial shortages were addressed. Financial markets began recognizing silver as a strategic asset class, distinct from other precious metals. Gold has historically served as a store value and inflation hedge, but its industrial applications are limited. Silver combines monetary properties with irreplaceable industrial utility, creating dual demand sources that provide price support during economic uncertainty. Investment funds specializing in strategic materials experienced massive capital inflows as institutional investors sought exposure to supply-constrained commodities with strong fundamental demand. The pricing trajectory reflected this evolving market understanding. Silver moved from $31 in early January to $45 by month end, with volatility patterns unlike traditional commodity rallies. Rather than sharp spikes followed by corrections, silver demonstrated steady, persistent gains that absorbed all available supply without triggering major sell-offs. Technical analysts noted that trading volumes remained elevated while open interest in futures contracts declined, suggesting that market participants were increasingly focused on physical delivery rather than paper speculation. Mining companies found themselves in an unprecedented position. Decades of low silver prices had discouraged exploration and development of new deposits. Most silver production comes as a byproduct of gold, copper, or lead mining, meaning that increasing silver output requires developing entirely new mining operations, rather than simply increasing extraction from existing sites. With silver prices rising rapidly and supply constraints likely to persist, mining executives began reassessing projects that had been economically unviable at previous price levels. However, the development timeline for new silver mines extends 7 to 10 years from initial exploration to full production. Environmental permitting, infrastructure development, and equipment procurement create lengthy delays that cannot be compressed through additional investment. The supply response to higher prices would not materialize until the early 2030s, meaning that current supply-demand imbalances would persist throughout the remainder of the decade. China's strategic calculation appeared increasingly sophisticated as the full implications became clear. By restricting silver exports, they had created supply scarcity that increased the value of their domestic reserves, while forcing competitors to pay premium prices for alternative sources. Chinese companies could continue accessing silver at controlled domestic prices, providing cost advantages in global markets for electronics, solar panels, and other silver-intensive products. The export restrictions simultaneously weakened foreign competitors while strengthening Chinese industrial competitiveness. The silver squeeze also revealed the interconnected nature of modern supply chains in unexpected ways. Automotive manufacturers discovered that electric vehicle production required significantly more silver than traditional internal combustion engines. Solar panel installations, promoted by governments as clean energy solutions, faced delays and cost increases that threatened renewable energy transition timelines. Medical device manufacturers found that silver's antimicrobial properties made it irreplaceable in certain applications, creating supply challenges for healthcare systems worldwide. Investment implications extended beyond simple commodity exposure. Companies with significant silver inventory positions, such as precious metals dealers, and industrial manufacturers with strategic stockpiles, experienced substantial balance sheet improvements as their holdings appreciated. Conversely, companies with large silver consumption requirements but limited inventory buffers faced margin pressure and potential production constraints that would persist until supply chains adjusted to the new reality. The crisis highlighted the critical importance of supply chain diversification and strategic inventory management. Organizations that had prioritized efficiency over resilience found themselves vulnerable to supply disruptions, while those that had maintained buffer stocks and alternative supplier relationships were better positioned to navigate the constraints. The silver squeeze became a case study in strategic resource management that extended far beyond the precious metals industry. As the initial shockwave settled into longer-term adjustments, several structural changes became apparent. Silver pricing had permanently shifted from a purely market-driven mechanism to one influenced by geopolitical considerations and strategic resource allocation. Industrial users were implementing more sophisticated inventory management systems that balanced carrying costs against supply security risks. Central banks were reconsidering their reserve composition to include strategic materials alongside traditional monetary assets. The global silver market had entered a new phase characterized by supply constraints, strategic competition, and fundamental reassessment of the metal's role in modern industry. The Chinese export restrictions represented not a temporary disruption, but a permanent alteration in how critical materials flow through the global economy. The implications would continue unfolding for years as markets, companies, and governments adapted to a world where silver availability could no longer be taken for granted. This transformation marked the end of an era when critical materials were treated as limitless global commodities, and the beginning of a new period where resource security would become as important as technological innovation in determining competitive advantage. The silver squeeze had revealed the fragility of globalized supply chains and the strategic importance of controlling critical material flows in an increasingly competitive world. The secondary effects began manifesting as constraints propagated through industrial networks. Aerospace manufacturers discovered that advanced avionics required silver-based solder joints for reliability. Medical device companies found silver's antimicrobial properties irreplaceable in surgical instruments. The automotive industry realized electric vehicles would require significantly more silver per vehicle. Each discovery added complexity to the supply challenge. Unlike gold, which serves primarily monetary functions, silver's industrial applications created baseline demand that remained constant. Hospitals could not delay procedures due to shortages. Aerospace companies could not compromise safety standards. The inelastic nature of industrial demand meant price increases would not significantly reduce consumption. Financial institutions began recognizing these dynamics and adjusting commodity exposure. Major investment banks published research describing silver as potentially the most undervalued strategic material globally. Pension funds began including precious metals exposure as a hedge against supply chain disruptions. Investment demand created additional pressure on constrained physical markets. Unlike industrial buyers who consumed silver in manufacturing, investment buyers removed metal from circulation. Exchange-traded funds backed by physical silver experienced unprecedented inflows as institutional investors sought exposure to supply-constrained commodities. This financial demand coincided with central bank recognition that traditional reserve assets might prove inadequate during geopolitical competition. The Chinese export restrictions demonstrated how resource control could be weaponized. Central banks began viewing silver as insurance against supply chain weaponization. The Bank of Japan became the most aggressive institutional buyer, authorizing purchases of 150 million ounces for strategic reserves after analyzing implications for Japan's electronics and automotive industries. Their strategy focused on building inventory to maintain industrial production for 18 months without external supplies. Industrial companies implemented sophisticated risk management strategies. Apple developed partnerships with recycling companies to recover silver from discarded electronics, creating closed-loop supply chains. Tesla invested in research programs aimed at reducing silver content in battery systems without compromising performance. These technological adaptations would eventually reduce silver intensity in certain applications, but development timelines extended multiple years. Meanwhile, growing adoption of electric vehicles, renewable energy systems, and advanced electronics continued increasing aggregate consumption. The geopolitical implications deepened as the crisis extended beyond supply chain management. Countries with significant silver mining operations found themselves courted by both Chinese and Western governments seeking processing partnerships. These resource-rich nations gained unexpected diplomatic leverage. Mexico emerged as particularly important due to its position as the world's largest silver producer and geographic proximity to American industrial centers. The Mexican government announced plans to develop domestic refining capacity that would reduce dependence on Chinese processing services. The European Union launched the Critical Materials Independence Initiative, allocating 50 billion euros to develop alternative supply chains for strategic resources, including silver, lithium, and rare earth minerals. The program aimed to reduce European dependence on Chinese processing by 75% within a decade. American policymakers faced pressure to develop similar strategic initiatives while managing immediate supply constraints affecting defense contractors. The Department of Defense established emergency procurement programs to secure silver supplies for weapon systems. These government responses created additional demand pressure as national stockpiling programs competed with commercial buyers. Silver had transformed from a commodity to a critical resource subject to national security planning. The pricing mechanisms adapted to reflect these realities. Traditional commodity exchanges continued operating futures markets, but physical silver increasingly traded at substantial premiums to paper contracts. Industrial buyers developed relationships with specific refineries, negotiating long-term agreements, prioritizing delivery certainty. The bifurcation between paper and physical markets created arbitrage opportunities, but logistics of taking delivery and limited availability meant spreads persisted longer than theory suggested. The silver market demonstrated characteristics more similar to strategic assets. Investment analysts began comparing silver to oil during the 1970s energy crises, when supply constraints created sustained price increases that altered global relationships. The silver squeeze was generating similar structural changes. The crisis revealed weaknesses in globalized supply chain design that prioritized efficiency over resilience. Decades of just-in-time inventory management and single-source relationships created vulnerabilities that competitors could exploit. As the crisis stabilized, the silver market permanently changed character. Supply security became as important as price and procurement decisions. Strategic inventory management replaced just-in-time delivery. The transformation reflected broader shifts in global relationships as resource control increasingly determined competitive advantage in critical technologies. The Chinese export restrictions demonstrated the strategic value of controlling refining infrastructure. The silver squeeze marked the beginning of a new era in commodity markets, where strategic considerations would increasingly influence supply, demand, and pricing dynamics. The implications extended beyond precious metals, establishing precedents for critical materials as tools of economic statecraft. This was not simply a supply chain disruption that would resolve through market mechanisms. It represented a fundamental reorganization of how critical materials flow through the global economy, with lasting implications for industrial competitiveness, national security, and international relationships. The silver squeeze had ended one chapter and opened another where control of critical materials would determine the balance of power.